Donald Trump is now pressuring China to stop purchasing discounted Russian oil and instead buy more expensive American crude. A bold pivot, especially from a president who once rallied crowds with chants of drill, baby, drill, urging U.S. producers to flood global markets with oil. But drilling is one thing, selling is another, especially at the scale the U.S. now produces. Finding buyers is a serious challenge. Rather than cultivating new markets, Washington has gone straight to the biggest. China. The message is clear. Ditch Russia's cheaper barrels and buy American. Beijing's response has been just as clear. No deal. As the White House leans on China, the U.S. Treasury is moving to raise an additional $100 billion through short-term bills to keep government operations running smoothly. Treasury Secretary Scott Bessent has taken a more diplomatic tone than Trump, framing Washington's push as a helpful suggestion that China reduce industrial output to rebalance its economy. But behind the language of cooperation lies a clear U.S. advantage. Such a shift would create room for American exports, long a Trump priority. The combined use of pressure and persuasion has created one of the most unusual economic standoffs in recent memory, one that highlights both the limits of U.S. leverage and the shifting dynamics of global trade. From the outset, Washington's campaign to sever China's ties to Russian oil was a long shot. U.S. officials issued statements, warnings, and even hinted at tariffs. But their approach rested on an outdated assumption that China could be publicly shamed or quietly coerced into compliance. That's not how Beijing operates. Its stance was direct. Energy trade is a sovereign issue, and politicizing it is unacceptable. The numbers back China's position. In 2024, it imported over 108 million tons of Russian crude, about 2.17 million barrels per day. This isn't a marginal source. It's a cornerstone of China's energy security and a financial lifeline from Moscow. These flows account for roughly a quarter of Russia's total oil exports. Replacing them with American barrels overnight was never realistic. Ironically, this situation stems from Trump's own energy agenda. He championed increased drilling and production to boost U.S. market dominance. Output soared. By 2025, U.S. crude production is forecast to hit record levels, between 13.4 and 13.6 million barrels per day, driven by shale and strong growth in the Permian Basin. But production doesn't equal dominance. Oil needs buyers, and in that arena, price and logistics rule. Russia and Iran have a built-in advantage. Their oil is cheaper, often trading $10 below Brent, and easier to deliver. Proximity to Asia, access to pipelines, and lower shipping costs give them a decisive edge. In 2025, Russia continued pushing large volumes across Asia. Chinese seaborne imports rose. India kept buying. Regional refiners snapped up the discounts. The math is simple. If you're an Asian refinery manager choosing between a discounted Russian barrel and a pricier American one with longer shipping times, the choice is obvious. Even refined products are part of the equation. China turns Russian oil into diesel, gasoline, and other fuels, some of which end up in Europe. The EU has tried to plug this loophole with stricter rules and price caps, but enforcement remains patchy. Russian origin products continue to flow through third countries, squeezing out American barrels in key markets. Despite record U.S. output, buyers remain limited. Logistical hurdles, refinery configurations, and cost differences all work against American crude. Many Chinese refineries, particularly smaller ones, are built for heavier grades like Russia's Urals crude. Switching to lighter U.S. grades would require costly retrofits, lower efficiency, and hurt profits. Under the G7 price cap system, Russian oil remains artificially cheap, giving Beijing even less reason to switch. Much of it arrives via secure pipelines or a growing fleet of tankers designed to bypass Western restrictions. Payments are increasingly settled in the UAE or through financial channels beyond Washington's reach. Even the once potent threat of losing access to the U.S. dollar clearing system has lost its edge. Today, China has built extensive legal, logistical, and financial buffers to shield its energy trade from American pressure. The reality is, Beijing isn't reluctantly buying Russian oil. It's fully invested in it. The economic, strategic, and geopolitical logic all align. And the more Washington pushes, the more resolute China becomes. This tug-of-war extends far beyond energy. Tariffs were raised to extreme levels. triple digits in some cases, to force China to rethink its trade model. It didn't work. China adapted. Its factories kept running. Its exports kept flowing. The disruption proved temporary. By early 2025, the Chinese economy had regained its footing. First quarter GDP grew 5.4% year over year, exceeding forecasts. The second quarter followed with 5.2% annual growth and a 1.1% increase from the previous quarter. Industrial output rose by 6.4%, with manufacturing up 7%. Strategic sectors performed even better. Equipment manufacturing jumped 10.2%, and high-tech output increased by 9.5%. Software and IT services surged 11.1%, while leasing, business services, transport, and logistics all posted strong gains. Retail sales followed suit, with consumer goods rising 5% and services growing 5.3%. July trade data also beat expectations, with exports up 7.2% year over year and imports rising 4.1%. Much of this growth was fueled by companies front-loading shipments in anticipation of future tariff hikes. China's trade surplus hit a record $686 billion in the first half of 2025, a 34% increase over the previous year. None of this happened by chance. Beijing responded to U.S. pressure with a deliberate counter-strategy, targeting politically sensitive American sectors with tariffs, pivoting toward emerging markets in Asia, Africa, and Latin America, and introducing domestic measures to support exporters. These included favorable credit terms, inventory support, and flexible pricing to maintain production. In the end, Washington's strategy didn't deliver the intended results. Tariffs raised costs at home and failed to force structural changes abroad. By August, U.S. officials began quietly retreating, delaying some tariff increases, reversing others, and negotiating temporary deals to reduce tensions. The reality had sunk in. The plan was falling short. Still, the pressure hasn't disappeared. Treasury Secretary Scott Bessent recently added another request, asking China to scale back manufacturing output. He framed it as friendly economic advice, a way to address overproduction, but the underlying message was clear. If China produces less, the U.S. might regain some of its lost ground in global manufacturing. That outcome, however, remains unlikely. China now accounts for nearly 30% of global industrial output. Its dominance is rooted in massive industrial zones where suppliers and manufacturers operate side by side. Components can be designed, tested, and revised in days. In contrast, the U.S.'s fragmented supply chains mean slower, costlier development cycles. This kind of industrial efficiency wasn't built overnight. It's the product of decades of infrastructure investment, workforce development, and coordinated national planning. Even if China were to reduce output tomorrow, no country could quickly replace its manufacturing capacity. Replicating it would require years of investment, new cities, a skilled labor force, and tightly integrated supply networks. Until that transformation happens, China's industrial lead remains firm. Meanwhile, Washington's financial engine continues to run on growing debt. The upcoming $100 billion round of short-term Treasury bills is one of the largest in recent memory. While the government is counting on strong investor demand, each new auction adds more pressure. Interest rates may rise further, and concerns over long-term debt sustainability are becoming harder to ignore. That's why Trump's coming meeting with Vladimir Putin is drawing attention. Stabilizing oil markets could ease inflation, calm investor anxiety, and give the U.S. economy a much-needed boost. A breakthrough, or even the appearance of one, could help Trump regain political and economic momentum heading into what's expected to be a turbulent election season. This moment is about more than just oil or trade. It's about power, priorities, and the hard truth of a multipolar economic world. As Washington keeps pressing, Beijing keeps pushing back. So far, with more effective results. If you want to stay ahead of what's coming next, make sure you're subscribed, because the next shift might just change how you see the global economy.